CXMT is about to list on the STAR market, poised to become the largest semiconductor IPO in Chinese history. Founded only in 2016, the company started by acquiring patents and talent from bankrupt German DRAM maker Qimonda, with nearly a decade of loss-tolerant capital infusion from the Hefei government. CXMT turned its first annual profit in 2025 and posted a staggering $7.3 billion in single-quarter revenue in Q1 2026. SemiAnalysis's 10,000-word research report breaks down CXMT's technology path, financials, HBM dilemmas, and IPO structure. A must-read for understanding China's position in the memory chip industry. The SemiAnalysis team first described the enormous memory demands from AI inference and agent workflows in their newsletter back in late 2024, and has since published multiple in-depth memory reports while continuously tracking CXMT and China's AI computing ecosystem. With CXMT likely to go public in the coming months, a dedicated deep dive is necessary that CXMT is poised to become China's largest semiconductor IPO and a milestone for the country's leading memory maker. From here, the competition between CXMT and Samsung, SK Hynix, and Micron will only intensify. The Silicon Valley returnee CXMT's founder, Yiming, earned his bachelor's degree in physics from Tsinghua University in 1994 and then pursued electrical engineering at Stony Brook University in New York. He worked in Silicon Valley for many years, becoming a project lead at MoSys, monolithic system technology. Around 2001 in 2005, Zhu returned to China with a set of SRAM patents and $100,000 in seed funding, founding GigaDevice, which later became one of the world's top NOR flash suppliers. But the global NOR flash market is far smaller than DRAM or NAND flash. Zhu's ambitions were bigger. He chose the DRAM battlefield. DRAM is not a game for fabless players. DRAM devours capital, has formidable patent barriers, and is intensely dependent on manufacturing prowess. By 2016, only 3 survivors remained in the industry: Samsung, SK Hynix, and Micron. Their moats built on 4 decades of accumulated patents and capital that no new player could breach. Zhu Yiming's SRAM patents and GigaDevice NOR flash business could provide neither DRAM cell design nor DRAM process technology, much less navigate around the patent blockade of the giants. So, when Zhu and the Hefei municipal government launched the DRAM project, Project 506, later CXMT. In 2016, the core technology had to be sourced externally. The source was a dead German company, DRAM Foundation. The Qimonda legacy, that dead company, was Qimonda. Qimonda went bankrupt in January 2009 due to the global financial crisis and the subsequent memory market collapse. But at the time it was Europe's leading DRAM manufacturer, a subsidiary of Infineon. Tracing its roots back to Siemens, Qimonda provided a rare alternative, a deep DRAM patent portfolio, and a memory cell architecture, both outside the Samsung Hynix Micron triangle. In June 2015, Polaris Innovations, a subsidiary of Canadian patent licensing firm Willen, bought roughly 7,000 patents and patent applications from Infineon for approximately €30 million. In December 2019, CXMT entered into a licensing agreement with Polaris, securing a large portfolio of DRAM patents. CXMT executives have publicly stated that they obtained around tens of thousands of patents, which became the foundation of CXMT's DRAM business. One key technology that CXMT inherited and developed from Qimonda is the 46nm class BWL buried word line. Memory cell BWL is a core architectural innovation. Traditional designs lay the access transistor gate along the wafer surface, whereas BWL buries the gate into a trench below the bit line. This provides three advantages. The cell shrinks to a 6F superscript 2 layout versus the traditional 8F superscript 2. The channel length is extended without consuming surface area to suppress short channel leakage, which impacts data retention, and gate-to-bit line parasitic capacitance is reduced. Buried word line plus stacked capacitor. That is the architecture all three memory giants use today. Qimonda, which had stubbornly stuck with trench capacitor technology, happened to retain the stacked/BWL technology in its reserve, and that is exactly what CXMT picked up. Talent. From frozen blueprints to living R&D capability beyond patents. The more enduring asset CXMT gained from Qimonda's collapse was engineers. Qimonda had a research and development center in Xi'an with 400 to 500 engineers, one of Qimonda's largest R&D bases outside Germany, after Qimonda's bankruptcy. Although the entire Xi'an R&D center was acquired by Tsinghua Unigroup, the broader dispersion of talent benefited CXMT. CXMT also successfully attracted senior engineer Karl Heinz Kuesters from Qimonda's German headquarters. Kuesters spent 24 years at Siemens, Infineon, and Qimonda as vice president of technology and pre-development. The pre-development pilot line he led was exactly the stacked capacitor approach. The very architecture CXMT adopted. He joined CXMT as a technical advisor, and times called Kuesters CXMT's trump card. What Kuesters brought was tacit know-how that no patents or 2.8 terabytes of documents can carry. 2 decades of experience leading DRAM development, allowing him to tell CXMT's engineers which Qimonda designs to keep, which to discard, and how to take a memory cell that worked in the lab into mass production. This integration and yield judgment cannot be found in any patent literature. The same pattern played out on the U.S. side. Ping Erxian, CXMT's vice president in charge of future technology evaluation, the person who publicly articulated the 46 nanometers to 10 nm class roadmap, did not come from Qimonda, but from a U.S. career spanning Micron, SanDisk, and Applied Materials. With deep accumulated expertise in memory and materials technology, CXMT also aggressively recruited talent from South Korea and Taiwan. South Korean prosecutors have indicted former Samsung employees for technology leaks, and it has been reported that dozens of Korean engineers worked at CXMT. The situation in Taiwan is similar, with CXMT continuously poaching top equipment and process engineers with generous salaries. This is the key to understanding CXMT's trajectory. Qimonda's patents are always a finite, expiring asset. What enabled CXMT to advance from G4 to G5, and then to HBM, is the assembled talent capability, locally cultivated talent, Chinese engineers returning after working at foreign firms, and a small number of foreign experts, not the documents. The legacy was merely the starting point. Talent turned the foreign legacy into an engine of indigenous innovation. But that engine burned for nearly a decade before turning a profit. The question is, who had the patience to keep feeding it fuel? The patience of state-owned venture capital. CXMT's success is hard to attribute to anything other than the strong support of Chinese local and central governments. The Hefei municipal government is a classic case. Hefei is a heavyweight hub for Chinese science and technology innovation. Over the past 2 decades, It has incubated a series of successful companies through its model of government-guided capital and supply chain clustering. BOE, a global top display panel maker. NEO, a leading EV maker, and now CXMT. The Hefei government did two crucial things for CXMT. First, it helped build a local supply chain around CXMT's fabs. The Hefei's approach is to take a large equity stake in the core chain leader enterprise, then attract the rest of the industry chain to cluster around IT. IT did this for BOE in displays, for NEO in EVs, and it replicated the same playbook for CXMT starting in 2016. Around CXMT's factory in the Hefei Airport Economic Zone, the government created a dense local industry cluster. Packaging and testing firms Peidun and Xianfeng are just a wall away from CXMT's plant, and over 99% of Xianfeng's revenue comes from CXMT. An on-site bulk gas plant operated by Guangdong supplies most of CXMT's needs, and Hefei Semiconductor, under PNC process systems, provides wafer reclaim capacity in the Hefei Xinjiang high-tech zone. That state-owned venture capital also directly controls upstream chip molding equipment maker Winnie Technology. Second, Hefei state capital was willing to lose money for a very long time. Unlike private equity funds that must deliver returns to LPs on schedule, Hefei's state-owned venture capital is ultimately backed by municipal and development zone state entities. With no exit clock, they continuously infused capital into a company that only achieved its first annual profit in 2025, accumulating massive losses over nearly a decade. The first phase of Project 506, launched in 2016, came from Hefei State Capital.in's subsequent funding rounds. Although Hefei State Capital was diluted, it never reduced its stake. Never exited by the time of the IPO. The largest shareholder holds 21.67%, and state-backed entities collectively control a dominant position. The willingness to treat a wafer fab as a decade-long bet rather than a fund cycle return. That was the catalyst that both technology and talent depended on, from legacy to autonomy. When these three threads come together, CXMT's first decade becomes clear. Qimonda provided the foundation. A licensed patent portfolio and memory cell architecture from outside the giant's triangle. Talent provided the motive force. Key figures like Kuesters and Ping, returnees from American giants, and controversial hires from South Korea, who turned frozen blueprints into an advancing process. Then the Hefei government provided what the first two needed, but could not generate on their own: capital, patience, and a localized supply chain. All three were indispensable. Now let's discuss CXMT's financials, technology, and equipment ecosystem. The next step after a decade. IPO amid a supercycle. While CXMT's first decade story is impressive, it may be just the early chapter of a much longer narrative. The company is preparing for one of China's largest semiconductor IPOs in recent years, and possibly the most closely watched semiconductor listing globally this year, in December 2025. The Shanghai Stock Exchange officially accepted CXMT's Star Market listing application. Market rumors had been circulating about the company's IPO preparation throughout 2024 and 2025. The latest development is that CXMT submitted its registration application to the China Securities Regulatory Commission on May 27 and is currently in the final review stage. CXMT's IPO prospectus disclosed a wealth of previously unavailable information. Combined with semi-analysis models, one can make a more precise Judgment about CXMT's current position and future direction at a high level. By virtually every metric, CXMT is already the world's fourth largest DRAM maker and is widening its lead over second-tier memory players. For the full year 2025, CXMT's revenue grew 156% year-over-year to approximately $8.6 billion, up from about $3.3 billion in 2024 and about $1.2 billion in 2023. Net profit also turned positive for the first time, reaching $1 billion. Even so, CXMT's 2025 revenue remained far below Samsung, roughly $72.3 billion, SK Hynix, roughly $52.1 billion, and Micron, roughly $37.2 billion, in DRAM revenue. In Q1 2026, CXMT reported revenue of $7.3 billion, up roughly 700% year-over-year, a single quarter nearly matching the entire previous year. Operating margin also expanded dramatically, reaching approximately 70%. SemiAnalysis believes this is just the beginning. Based solely on prospectus disclosures, the company's first half 2026 revenue is expected to increase sevenfold year-over-year, exceeding $16 billion. For the full year 2026, SemiAnalysis estimates CXMT's revenue could surpass $50 billion if achieved. This means the company has more than doubled its revenue every year since 2023, with a 2026 year-over-year increase exceeding 6 times. The driver of this explosive growth is less about technology or market share and more about the cycle itself. Looking closely at the data, in Q1 2026, CXMT's bit shipments grew only 11%, but ASP, average selling price, rose about 57%, following sequential ASP jumps of 63% and 68% in Q3 and Q4 2025. That what is really supercharging the performance is explosive price increases, not a significant market share grab from competitors. In bit shipment terms, SemiAnalysis models show CXMT's market share growing from 9% in 2025 to 12% in 2027. At a 3 percentage point share gain may seem small, but in a market SemiAnalysis forecasts to approach $1 trillion in size by 2027, it is enormous. The myth of a China memory flooding the market narrative for readers who have not closely tracked CXMT or the memory market. A more interesting finding is how CXMT's pricing compares to industry leaders. Based on memory model data, CXMT's DRAM ASP challenges a common misconception that Chinese memory is structurally cheaper and will flood the market, crushing global prices. This may have held true in some past cases, but it is not accurate in the current cycle. Take Q1 2026 as an example. CXMT's DRAM ASP was only about 5 to 10% lower than Samsung SK Hynix and Micron. SemiAnalysis expects this directional trend to hold throughout 2026, though the gap will gradually widen. The widening is not due to inherent pricing differences but to product mix shifts. The top players have a higher share of server DRAM and HBM in their shipments, and server DRAM has a stronger pricing outlook than commodity DRAM. By the end of 2027, SemiAnalysis expects server DRAM and HBM to account for more than 50% of DRAM in-market demand, with server DRAM and HBM commanding higher dollars per gigabyte. The top players will further extend their ASP lead over CXMT, especially considering the anticipated sharp HBM price increases in 2027. Profit margins. a gift of the cycle-strong ASP tailwinds have significantly improved CXMT's margins. Full year 2025 gross margin reached 37.8%, closing in on Samsung's 39.4% and Micron's 39.8%, but far below SK Hynix's 60.4%. SK Hynix benefiting from a higher HBM shipment ratio. CXMT's roughly 38% gross margin is a massive leap from minus 113% in 2023 and minus 4.7% in 2024.2025 was not only a historical high for CXMT's gross margin, but also the first year the company achieved a positive gross margin. Entering 2026, margins improved further. Q1 operating margin reached 70%, compared to 73% for SK Hynix, 81% for Samsung, and 84% for Micron in the same quarter. Beyond ASP growth, CXMT's margin improvement also benefits from its product mix, which is almost entirely focused on commodity DRAM. And in the current environment, commodity DRAM margins are actually higher than HBM margins. According to the prospectus, about 99% of the company's bit shipments in 2025 were traditional LPDDR and DDR products, with HBM contributing minimally to revenue and profits. A simple DDR5 unit cost analysis makes the picture clearer. SemiAnalysis finds that CXMT's DDR5 cost per bit is still over 30% higher than the big three. Yet, because DDR5 pricing was extremely strong in Q1 2026, CXMT's gross margin was still pushed above 70%. This means CXMT's margin improvement is predominantly pricing driven, not the result of a material step up in product competitiveness or cost structure. Capacity expansion. Closing in on Micron beyond record profits, CXMT is also catching up in capacity. By the end of 2026, SemiAnalysis expects CXMT to reach about 350,000 wafer starts per month, wspm. Just shy of Micron's roughly 385,000 wspm, in terms of wafer capacity. CXMT is on track to become the industry's third largest memory manufacturer, but significant gaps remain with the two giants. Samsung at around 720,000 wspm. SK Hynix at around 595,000 wspm. By 2027, with the initial ramp of Shanghai Phase 1 and full utilization at Hefei and Beijing, CXMT's capacity could reach around 420,000 wspm, roughly 17% of global DRAM capacity, up from around 13% in 2025. In bit share terms. This rises from 9% in 2025 to 12% in 2027. By 2028, with Hefei fully loaded and the two Shanghai phases continuing to ramp, SemiAnalysis expects CXMT to reach 500,000 wspm, accounting for about 17% of global DRAM supply. Oversupply fears. Nothing to worry about for at least 2 years. Given CXMT's growing role in global DRAM capacity, investors worry, as they do in every cycle, that a Chinese player could cause a supply-demand imbalance. SemiAnalysis believes these concerns are heavily overblown for at least the next 2 years, after factoring in incremental capacity and bit shipments from CXMT and other memory manufacturers, and assuming utilization rates above 90%, DRAM supply remains extremely tight. Consider CXMT's capacity expansion pace alone, about 85K, 70K, and 80K wspm. Additions annually in 2026, 2027, in 2028 versus Samsung's 15K divided by 50K divided by 110K, SK Hynix's 60K divided by 60K divided by 90K, and Micron's 30K/90K/115K. Even with all these additions, DRAM will remain in a high single-digit percentage deficit in 2026, with the shortfall widening to a low to mid-teens percentage in 2027. That SemiAnalysis has previously detailed why DRAM could remain undersupplied through 2028. CXMT does not have the ability to irrationally accelerate capacity expansion beyond its current cadence to disrupt the market, simply because fab construction lead times are too long. The extremely favorable pricing environment is precisely the primary driver of CXMT's performance blowout, and CXMT certainly wants that environment to persist. SemiAnalysis's tracked fab construction progress shows no sign of such a possibility, though it should be emphasized that the Shanghai site at full load has total wafer capacity potential exceeding 400,000 wspm. CXMT's dilemma when it comes to HBM, CXMT's wafer allocation is very limited at the end of 2025. Out of CXMT's approximately 265,000 wspm capacity, only around 5,000 wafers were allocated to HBM. SemiAnalysis expects this figure to rise to about 30,000 by end 2026 and around 55,000 by end 2027. This aligns with the prospectus disclosure that roughly 99% of 2025 revenue came from DDR and LPDDR, but this allocation pattern may change. China's push for AI computing self-sufficiency could conflict with the company's commercial priorities, and that push is expected to strengthen over time. SemiAnalysis has incorporated government guidance for CXMT to tilt capacity toward HBM in its forecasts, anticipating an accelerated expansion of HBM capacity in 2027 and 2028. CXMT's HBM capacity is projected to reach 55,000 wspm in 2027 and 100,000 wspm in 2028, increasing its share of global HBM wafer supply from 1% in 2025 to 12% in 2028. It must be remembered that CXMT, unlike other memory makers, is not just an economically and technologically important company. It is a strategic asset that the state can leverage to advance priority policy goals. From a near-term commercial logic standpoint, it makes sense for CXMT to prioritize capacity for commodity DRAM over HBM. Commodity DRAM currently offers significantly higher margins than CXMT's HBM products, and the bit output per wafer area is more than 3 times that of HBM. At a stage where HBM technology is not yet mature, heavy HBM allocation would consume scarce wafer capacity that could otherwise generate higher margin, higher volume commodity DRAM. But China must push forward its HBM layout because HBM sales to China are severely restricted by U.S. export controls, with Korean makers' shipments to China sustained only through certain loopholes. HBM technology gap in terms of technology readiness. SemiAnalysis believes CXMT is still struggling to stabilize mass production of HBM 3.8 high, with 12 high posing even greater challenges. On the front-end side, CXMT has made progress on production stability at its G4 node, equivalent to the 1Z node, and the majority of its 2026 DRAM output will be based on G4. However, the DRAM core dies used for HBM, due to larger die size and stricter performance requirements, should have significantly lower wafer sort yields than commodity DRAM. SemiAnalysis believes front-end yields remain a major challenge for CXMT, with the gap to rivals still large, while G4 yields have improved. The relatively low margins in 2024 and 2025 suggest they likely remain below the industry standard mature yield level of 85 to 90% for the 1Z node. This implies that equipment constraints and manufacturing experience are persistent hurdles CXMT still needs to overcome. The next generation process node G5, equivalent to the 1A node, can theoretically advance without EUV lithography, just as Micron's 1A did, but will face increasing manufacturing and design challenges. These challenges will be further amplified when applying that node to HBM DRAM dies. Die stacking is CXMT's biggest obstacle in HBM. HBM stacking typically brings severe technical problems: thermal stress, die cracking, warpage, bonding defects, and yield loss across multiple tiers. These issues become even worse when moving from HBM3.8 high to HBM3.12 high and HBM3E, as CXMT's manufacturing experience with 12 high and above HBM is still insufficient. The stacking dilemma is not unique to CXMT. Top players are also facing die cracking, thermal management, and yield loss issues on 12 high HBM 4.16. High and even 20 high are trickier. One reason Rubin Ultra is expected to adopt 12 high HBM4E rather than 16 high is supply. 16 high requires more DRAM wafers, is harder to manufacture, incurs greater wafer loss, and results in less effective bit supply. SemiAnalysis believes it is increasingly likely that CXMT skips HBM3 and focuses directly on HBM3, E8 high, and 12 high. There are two reasons. First, customers in the 2027 time window will need more competitive HBM products. Second, mainstream accelerators at that point will be using HBM3E, HBM4, and HBM4 on the back-end packaging side. While there is still debate over whether CXMT uses MRMUF or TCNCF, the packaging challenges are relatively more manageable because the company and its assembly and test partners face fewer restrictions under export controls. That CXMT has been working closely with leading OSATs like Tongfu Microelectronics, and back-end capabilities should be gradually improving, though a gap with the top memory makers remains. Based on existing manufacturing challenges, SemiAnalysis models CXMT's HBM3.8 high front-end and back-end yields at approximately 35% and 70%, respectively, for a combined yield of only about 25% HBM312 high or HBM3E12 high. With even higher stacking and bonding difficulty, should have even lower combined yields to AT these yield levels. For the same wafer capacity, CXMT's HBM output is far below that of the top players. More critically, the HBM that is produced has extremely low margins, especially when compared to commodity DRAM in the current pricing environment. CXMT's HBM dilemma is also reflected in its product adoption. SemiAnalysis believes that only Huawei, Cambricon, and a few emerging Chinese AI chip startups may adopt CXMT's HBM, though adoption rates could be very high. Domestic AI accelerator makers still prefer to use foreign HBM3 or even HBM3E. Wherever possible, whether through any available channels or from inventory stockpiled before the December 2024 export controls. AS capex and computing infrastructure spending by Chinese domestic cloud providers grow rapidly. Demand for indigenous HBM is also surging. One notable exception: Huawei and CXMT are developing a customized HBM that does not rely on JEDEC standards and PHY, which will help offset the bandwidth disadvantage. The HBM supply constraint facing China may be more severe than what the slow development of domestic HBM alone implies. The three major HBM suppliers themselves have tight supply, and under the December 2024 U.S. export controls, they have been restricted from selling HBM2E and more advanced HBM products to China. In a tight supply environment, these players have even less incentive to risk violating the rules to sell to China. But HBM transshipment and smuggling further complicate the picture. SemiAnalysis understands that some Chinese companies are still obtaining HBM3 through various channels. Transshipment via overseas offices or third-country partners remains a route. Some third-country OSATs or intermediaries are facilitating these flows. Certain entities export incompletely assembled systems or modules, not considered finished GPUs or ASICs, thus still allowed for export to China, and the HBM is subsequently disassembled and repackaged onto domestic GPUs or ASICs. What the IPO structure reveals, CXMT is likely to be one of China's largest semiconductor IPOs, and its equity structure deserves more attention than the headline financial figures. That CXMT reported a consolidated net profit of 7.14 billion renminbi in 2025, but the net profit attributable to shareholders of the parent company was only 1.87 billion renminbi, with 74% going to minority interests. The reason lies in the shareholding structure. CXMT holds only 30.68% of the economic interest in CXMT Xinjiang and 31.72% in CXMT Jidian Beijing. Yet it controls 73.01% and 75.32% of their voting rights, respectively, through long-term acting in concert arrangements. This allows the company to consolidate wafer fabs that it mostly does not economically own, so the consolidated figures overstate the profit that public shareholders can actually claim by about 4 times. The same voting structure also makes the company's statement of no controlling shareholder and no actual controller less than convincing. The prospectus lists it as a formal governance risk. CXMT exercises majority voting control over the fabs through acting in concert agreements, and the China National Integrated Circuit Industry Investment Fund Phase 2, along with Hefei and Anhui state-owned entities, collectively hold well over 30% post-IPO. This arrangement appears designed to manage export control and foreign investor perceptions at a time when CXMT's relationship with the Chinese government is under maximum scrutiny. Valuation. The undervalued floor price. CXMT plans to raise 29.5 billion renminbi, approximately $4.1 billion, by offering 10 to 15% of its total post-IPO share capital. Financing entirely through the IPO means the implied per share price is about 4 renminbi and 41 cents at 10% dilution and about 2 renminbi and 78 cents at 15% dilution. The last funding round in June 2025 was at 2 renminbi and 63 cents. The low-end price represents almost no premium over the previous round, despite the fact that Q1 2026 has already delivered $7.3 billion in revenue and $4.8 billion in net profit. RMB 2.78 corresponds to a valuation of roughly 197 billion renminbi, around $27 billion, equivalent to only 1.8 times the Annualized first half 2026 attributable net profit that SemiAnalysis believes this valuation floor is far too low, and the actual pricing should be much higher. Use of proceeds. Focus on commodity DRAM. No mention of HBM. The usage plan for the 29.5 billion renminbi in proceeds reinforces CXMT's current priorities. Of the total, 20.5 billion renminbi, 69.5%, is earmarked for wafer production lines and DRAM technology upgrades, and 9.0 billion renminbi, 30.5%, for forward-looking DRAM research. The prospectus does not disclose any dedicated HBM project, nor does it even mention HBM. The project descriptions focus on newer process platforms, product iterations, and migrating existing lines to mid to high-end DRAM. The core function of the IPO is to strengthen CXMT's DRAM manufacturing and technology base, with no public capital commitment to near-term HBM expansion. A caution on cycle timing. The magnitude of profit swings calls for a reminder about cycle timing. In its December 2025 prospectus, CXMT had guided for a full year 2025 attributable loss of 0.6 billion renminbi to 1.6 billion. 5 months later, the updated prospectus reported an 1.87 billion renminbi profit, with consolidated profit more than doubling the high end of the prior estimate. This also illustrates how quickly DRAM top-of-cycle pricing can change the valuation denominator in both directions. Alibaba's dual role. One final detail. Alibaba's role on CXMT's shareholder register reshapes how one reads CXMT's demand side. Alibaba Cloud is simultaneously a core hyperscale customer and a near 4% equity shareholder and endorser, alongside Zhu Yiming's GigaDevice, holding roughly 1.8%. The magnitude of domestic demand is, to some extent, secured, an advantage the Korean giants never had in their home market. The percentages may be small, but the significance is far greater.